Hello, and welcome to the Dassault Syste mes third quarter 2025 presentation. For the duration of the call, your lines will be on listen-only mode. However, you will have the opportunity to ask questions at the end of the presentation. This can be done by pressing pound key 5 on your telephone keypad. I will now hand over to your host, Stacey Pollard, to begin today's conference. Please, madam, go ahead.
Hi, this is Stacey Pollard with Dassault Syste mes. Thank you for joining our third quarter 2025 earnings conference call with Pascal Deleuze, our Chief Executive Officer, and Ruben Bergman, our Chief Financial Officer. Before we begin, some quick notes. Dassault Syste mes results are prepared in accordance with IFRS. The financial figures discussed on this conference call are in a non-IFRS basis, with revenue growth rates on a constant currency basis unless otherwise noted. Some of the comments on this call contain forward-looking statements that could differ materially from actual results. Please refer to today's press release and the risk factors section of our 2024 Universal Registration Document. All earnings materials are available on our website, and these prepared remarks will also be available shortly after this call. Now, due to technical delay, we've lost some time, and due to the technical issues, Ruben is going to summarize more quickly than we'd originally planned in order to save time to address your questions. So both Ruben and Pascal are here, and Pascal will now take over. And Ruben will take over.
Thank you, Stacey, and we apologize again also for the technical delay, but we promise you we will make up for it to make sure we have enough time for your questions. So as Stacey was just saying, I'm going to give you a brief overview on the quarter, but also I want to spend some time on the guidance before we then open up for Q&A. So let me start first of all, and thank you again for joining us on today's webcasted call here, and good morning to you in the United States. So I want to start with three key messages. The first one is top-line growth and margin expansion are our top priority. The second message is the 3D Experience platform is driving our business model shift to subscription and recurring revenue growth. And this engine is working with 16% growth in subscription this quarter. And third message is we are mission critical to our client. And in fact, in 2025, we are winning significant contracts with many of the top industrial companies in the world. And this is laying the foundation to long-term value creation with cloud and 3D universes. It is these powerful long-term partnerships that give us confidence in our long-term targets. Now, a few more comments. Our financial results for the quarter were solid with 5% revenue growth and an expanding operating margin up 100 basis points and 10% EPS year-over-year growth. Industrial innovation is driving the growth, which was up 9% in the quarter and 8% year-to-date, while Medidata and Centric were softer than expected. As discussed previously, the repositioning of Medidata is ongoing. The change of the model to reduce the dependency on clinical trial activity will take time, as we are doubling down on the enterprise and PLM opportunity in life sciences. And for Centric, we are accelerating the SaaS transition. And to this effect, we also have promoted a new leadership team. Now looking at the full year, we adjust our revenue outlook to 4 to 6% growth XFX in line with our current trajectory of 5% top-line growth year-to-date. At the same time, we maintain our EPS growth target of 7 to 10% XFX growth thanks to the strengthening of the operating margin driven by efficiencies we are generating in the business. Now, with this in mind, a few more details on the quarterly results. Q3 and year-to-date total revenue and software revenue were both up 5%. Recurring revenue was strong, up 9% in the quarter, and it highlights a very solid acceleration when compared to 7% year-to-date for recurring. Subscription revenue growth was 16%, and it was driven by new deals signed in the quarter and the increasing visibility from large contracts that are ramping. As a result, subscription revenue now represents almost half of the recurring revenue base, which is up 3 points from last year. And starting in 2026, subscription will surpass maintenance revenue in absolute terms. 3D Experience revenue was the growth engine behind that, which was up 16% in the third quarter. The signings at Ford and Apple contributed to the strength in subscription growth. Upfront license revenue declined 13% as our clients continue to adopt the subscription model at an increasing rate. The best proof of this is that recurring revenue now accounts for 84% of our software revenue year to date. The operating margin improved 100 basis points year over year for the quarter, driving strong EPS growth of 10% thanks to productivity gains and cost discipline. In fact, the expense growth was up 3.1% in the quarter, and we continue to rebalance resources to support our growth strategy. So I stop here on the overview, and I will now turn to the financial objectives. So the net is that our year-to-date revenue is up 5%, and for the full year, we now adjust our outlook to reflect this trajectory. And so we expect a growth of 4 to 6% XFX for both the total revenue and software revenue, with a 6 to 8% growth previously. When you look at this adjustment in absolute terms for the full year, this reflects an adjustment of about 140 million to the midpoint. And of that, there's an impact from Q3 of 30 million and an FX impact of about 20 million. Now, the remaining delta can be explained by three factors. It's first, the lower growth from Medidata in line with Q3. And I guess we'll discuss that. Medidata growth was minus 3% and life sciences growth was minus 3% in the quarter. I just add that because we were not having the time to go through all the details. The second part is that the impact of the SaaS acceleration of Centric. And the third element is an increasing macro volatility with the potential to impact the timing to close large transactions. So here we are reflecting the potential of delay in decision-making on some of our large contracts with the potential to impact our Q4 closing. And please also remember, we had a high comparison base in Q4 last year. Now, looking forward, the change of model for Medidata is ongoing, and we are confident in the accelerated SaaS transition for Centric, given its strong positioning in a very large market, and clients are endorsing it. For industrial innovation, we have built a strong foundation in 2025 with signing significant contracts, and also we expect in 2026 to expand on these partnerships to continue to transform our customers with virtual companions and generative experiences. And to add to this, SolidWorks momentum was strong in Q3 and also year to date. Now, looking at the recurring revenue outlook, it remains stable at 7 to 8%, and it's underscoring what I said at the beginning. We're implementing a sustainable recurring growth model with an increasing visibility. Above all, we have the strengthening of our operating model highlighted by margin improvement. And as such, we are maintaining our EPS growth expectations for 7 to 10% XFX or €1.31 to €1.35. To achieve this, we expect Q4 OPEX to continue the trend of Q3. We expect Q4 OPEX to continue the trend of Q3, delivering margin expansion of 100 basis points driven by ongoing productivity initiatives. Now, briefly to Q4. As you can see, the revenue range of 1 to 8% is fairly large. And this predicates the potential uncertainty and timing of large deal closing, mainly for the upfront license business, while subscription growth of 8 to 12% is solid, also comparing to a high base last year. Operating margin is expected in the range of 37.2% to 38%, and EPS growth of 7 to 17% XFX to reach 41 to 45 cents EPS for the quarter, reflecting the ongoing operating leverage. Now, as I reflect on our performance so far this year, I want to highlight that our operating model is resilient, and we apply strict financial discipline to support our long-term growth. We are occupying a leading market position, which makes us mission-critical today and tomorrow for our clients. Profitable growth and improving cash conversion is a top priority with a clear objective to show results, improving results starting in 2026. AI and cloud are our two main growth drivers, and we are confident that we will deliver on their ambitious growth targets. We are committed to invest right for innovation, customers, and shareholder value. And with this, we are turning to the Q&A.
Thank you. As a reminder, if you wish to ask a question, please press pound key 5 on your telephone keypad. Our first question comes from the line of Jay Vleeschhouwer at Griffin. Your line is open. Please, sir, go ahead.
Thank you. Good afternoon, Pascal and Ruben. A few things, of course, as always. Ruben, you mentioned in passing some productivity initiatives. Could you elaborate on that? Are there any operational adjustments that you are making with respect to any or all of go-to-market, perhaps affecting CSE or CPE, product packaging, in other words, anything having to do with the portfolio, perhaps even any levels of management, anything in detail of that kind that you can talk about in response to some of the growth inhibitions you spoke about would be very helpful.
Okay, thank you, Jay. I can start. Thank you for the question. The productivity initiatives are ongoing for quite some time. We are focused on putting the right people at the right place to support our growth initiatives. With AI and 3D universes, it's a huge. We're creating new categories of applications for our clients, and this requires to make sure we have the right skills as well as the right people to support these ambitious roadmaps in R&D, for example, and this is very well managed by our R&D organization. As it relates to the go-to-market, there are several points to take. I think you heard us talk about the indirect business, which is a key focus on rejuvenating and recalibrating our partners. I think you see already good evidence of this in our SolidWorks numbers for the role partners. There's good momentum that we are creating. We are working actively on the process partners to make, to have the changes that we are planning to also drive impact, which is not yet so visible, but we are working on that on the process partners. As it relates to, for example, to our life sciences business, we are here. The objective is to evolve our go-to-market and offering to be enterprise, to embrace the enterprise, to be enterprise-wide, to expand from the focus of clinical development across the whole value chain of life sciences and the entire patient journey. Therefore, we are recalibrating our go-to-market and our offering. This is in process, and this is what we are expecting. We are seeing results right now already, but of course, this is to be expected to turn in 2026 also into growth for life sciences overall, which we don't see yet. We are also looking at our service business. Service used to be a time and material business. Today, it becomes an outcome-based business. When we talk about virtual twin as a service, as an offering, which is really delivering outcomes to our clients. It requires a repackaging of our software and services to be combined to deliver real outcomes for clients. This is in full execution, this transformation. Just to mention a few on the business side. You heard us talk about Centric as well. For Centric, we are focusing on really transitioning this business to become SaaS and cloud first. This decision has been made. Now we're executing along those lines. From a cost structural standpoint, really here the focus has been for us to capitalize on past and existing investments and to ensure that we grow revenue faster than expenses, which then automatically translates into EBIT expansion. And you see that in Q3, and we are committed to do that in Q4 and going forward.
Okay.
That's to give you a few examples.
Thank you. You mentioned some large signings, which I assume you were alluding there to industrial innovation large signings. And so the question there is, are you seeing the customary programmatic adoption that DS has seen for decades in aero and auto behind those signings, or something perhaps more structural or transformational in terms of the adoption that those signings are based on? In other words, are you seeing a mix in terms of why customers are doing the signings? Is it just a conventional new aircraft program from Boeing or whomever versus something broader and on a more ongoing basis that would not only affect CSE, but eventually, move out into CPE Tier 2 and Tier 3?
So, Jay, Pascal speaking, it's a very good question, in fact. You're right, for a long time, the deployment of our solution was extremely linked to the programs, whether it's an aircraft or an auto. With AI, I think we are seeing a different trend, which is much more how we could accelerate the transformation, leveraging the platform, which is ready for AI, across the entire chain. So obviously, including the large OEM you are referring to, but also the suppliers. This morning, I was mentioning the Ford case. As you may know, we signed a 5-year contract with Ford to deploy the platform across all the programs. So it's not only the EV, but also the traditional one. And this is also including the supply chain. So it's exactly your point, which is this has a drag effect automatically on the supply, because at the end, this AI story is something you cannot segregate, if you want, between different companies. You have to look at the extended enterprise if you want to unlock the value. So this is opening this. This is definitively accelerating the trend for the adoptions.
Okay, a couple last things, if I may. Could you comment, Pascal, Ruben, on the rationale behind the new renaming within the SolidWorks business? In other words, you're returning to your roots of SolidWorks branding. Maybe talk about why you did that, what go-to-market effects that might entail, and more broadly, the company has been adhering to a solution selling concept for years, but perhaps do you reconsider that or evolve that in some way as you've done just now with SolidWorks?
So I will take it with what if you want, Ruben, but feel free to add whatever you want. So, yeah, SolidWorks is an umbrella for the mainstream market, right? And that's the reason why we are creating the Works family, whether it's DeliaWorks or SylviaWorks. But at the end, SolidWorks is really the umbrella, because the large community we are serving are the SolidWorks users. Now, we do not want to be solution or industry-oriented with SolidWorks. We have to be industry-aware, which is very different. When you are industry-oriented, basically you package your solutions to fit precisely for market segments. And this is what we do for most of our product line. But we do not intend to do this for SolidWorks. SolidWorks, nevertheless, has to be industry-aware, which means there are certain features which are extremely relevant for one industry. There are certain model foundation with artificial intelligence, which will be extremely relevant for certain industries, and we want SolidWorks to take the benefit of it. So this is the way to approach it. This is a way to package it. And last but not least, and I know, Jay, you are a SolidWorks lover for a long time, and my motto is red is red, meaning we need to keep the ease of use of SolidWorks across the board, because this has been for a long time a key differentiation for SolidWorks. And AI, in a way, is giving another way to ease even further the usage of the solutions, because this is basically managing the complexity of sometimes very advanced workflow, like what you can do in simulations. So those are what we are currently doing with SolidWorks. And by the way, you should celebrate the anniversary of SolidWorks, because this year is the 30 years anniversary of SolidWorks. And I think over the last 30 years, we have built an amazing community.
Okay. 3D universes are still very early, obviously, but you did give a very specific outlook for it at the meeting in Paris in June. Between now and then, that is to say 2029, what kind of additional or new metrics do you think you will be providing us to help us understand the progression towards that very large goal that you set for several years from now? Are you going to give specific revenue milestones or any other kinds of metrics like that to substantiate your ambition for 3D universes?
There are two ways to answer to your questions, Jay. One, Ruven, during the Capital Market Day, made basically an explicit commitment. We say over the period of the plan, $500 million will come from there, which is the combination of the AI and also the acceleration of the cloud, right? So at the end, in a way, we will give you, maybe not on a quarterly basis, but on a yearly basis where we are. And the second thing is, probably more important, is the attach rate. Because remember, the way we are structured the portfolio is the following. We have roles, processes, and solutions, and we are, with AI, creating a new category of solutions. We do not want to replace what we do. We want to complement and extend. So in front of the role, you have the virtual companions. And this quarter, we released 3. That was part of my presentation this morning, right? And they are concrete examples, and they are available on the market. And basically, we expect to have some revenue coming in 2026 from there. In front of the processes, we have the generative experiences. And right now, we are focusing on the use cases, which are really the one creating a real breakthrough. So we are not looking for a small improvement in the processes, if you want. We really want to create a moonshot, so it's at least 5 times, if not 10 times, improvement of the way to work currently. And for this, it will be a token-based approach, a usage-based approach, which will facilitate the adoptions. And then in front of the solutions, you have what we call the virtual twin as a service. Is really, rather than to sell the tools, we are selling the output of what we are creating with it. And it's a combination between the technology we have with the services capabilities we have, either from us or from the ecosystem, in order to better serve our partners. So if you mix all those 3, we have new categories, new business model, complementing what we do, leveraging what we do, and I think we have a clear roadmap. So on a yearly basis, clearly, we can give you some data point on the projections of the revenue stream. And we have a concrete roadmap for 26 and 27, so almost every quarter we will come back with the new capabilities, the new category of solution we are introducing on the market, just for you to understand the attach rate between the roles, between the process, and between the solutions with all the new categories I've just mentioned.
Thank you. Our next question comes from the line of Nicolas Edmond at Oddo. Your line is open. Please, sir, go ahead.
Yes, good afternoon, Pascal. Good afternoon, Ruven. Thank you for taking my question. I have 2, actually. The first, coming back on Centric, I would like to understand what really triggered this decision to move or to accelerate the move to SaaS, as it was pretty clear from the beginning of the year that you would be facing super tough comps in H2. But at the beginning of the year, if I'm not wrong, you seem to be betting again on strong upfront revenue coming from renewals. And even at the time of Q2 earnings, it seems that you were still believing that you would have some upfront revenue. So it seems that his decision was made pretty recently, and is this decision linked to the fact that you acquired the remaining shares of the company, which freed you from any constraint to do that or something like that? And my second question is regarding the acceleration of the move to subscription and beyond Centric this time. Is this time a move on which we have a greater control, or does it remain in the hand of customers mainly? They still have a choice, and the fact that you still don't have total control on that may explain the lower than expected license in Q3 and the very broad guidance range in Q4. And at a certain point of time, do you intend to get a better control of the phasing of the move to subscription, or do you still think that letting the client choose is still the best solution? Thank you.
Thank you, David, for your question. I will start with us and add whatever you want. So, Centric, there are two reasons behind this decision to accelerate the transitions or the acceleration to the SaaS business model. One is the one you just said, which is we acquire the remaining piece. So obviously, when valuation is at stake, I think it's not. It's probably better to do it just after, because we know that this could have an impact on the revenue stream, and it's right now in our full control. So this is basically much more the technical reason, let's say. The fundamental reason is much more simple of this. I had a chance to meet with many of Centric customers, and many of them are requesting to move to SaaS from a product standpoint, but also from a business model standpoint. And the reason is because the market they serve is still doing a lot of merger and acquisitions. So it's really an easier way to connect the systems together. It's much more fast in terms of adoptions. And many of the Centric customers are also SAP customers. And many of them are moving to SAP HANA currently. So they want to move this. They want to do this move in one single shot, if you want, to have the complete SaaS architecture being the foundation for their information systems. So those are the two fundamental reasons why we are accelerating for Centric. Coming back to the subscription, and there are two ways to answer to your questions. One is, for sure, we will continue to offer the upfront license model along the side with the subscriptions. And there are fundamental reasons for this. One is because there are certain industries which are, CapEx-based, and we need to respect this. And the upfront system is much more convenient for them. There are certain industries like the defense, they do not want you to operate the software for them. Does not mean that at the end the license will not be cloudified if you want, but we will definitely not be the one operating the system for them. And you have certain countries like China where the subscription and the SaaS will not be widely adopted for a certain fraction of the market for obvious reasons. So if you do the sum of this, the upfront license is a little bit less than $1 billion over the year. For 1 year, it will progressively reduce to $500 million. But I do not expect this will be below this. Now, why I'm saying this is because for all the others, obviously we are pushing the subscriptions, especially for the large contracts. And there is one simple reason for this. Most of the large contracts have a cloud component right now, because usually it's a minimum of 5 years commitments, and the reality is the system we are developing is extremely, sticky. So you do not make this investment only for 5 years. Usually you do it for a minimum of 10 years. So clearly for them, they need to integrate the cloud architecture in what they do. So the cloud business model is coming with it, and that's an easy way for us to push along this way. Then after you have the indirect channel. And this is maybe where it's a little bit tricky. Let me explain to you why. Because for the partners, there is a bit different from a cash flow standpoint between the upfront and the subscriptions. And the danger is what? It would have been easy for me to put a lot of incentive for them to move to subscriptions. If I do that without having tight control, the risk I'm taking is for them to repurpose the large support and maintenance revenue stream we have, thanks to the large install base, into subscriptions without expanding the scope of what we do. And the entire purpose of the SaaS business model for us is to expand what we do. So that's the reason why I do it basically sequentially, and we do it with some specific offer. Now, if we step back, I think if I link the previous conversation I had with Jay about how the platform is used now with the cloud and how the supply chain is also endorsing the platform in order to unlock the AI capabilities, it goes with it. For SolidWorks, I think the subscription is right now exceeding 35% of the total of the mix. We are gaining in the mix almost 5 points every year. But we see this accelerating. So in, let's say, I guess in the head of 2026, probably we will be at 50% already. The net of this, and this is what Ruven was saying, at the end, if you look at the recurrent revenue, the subscription is already being at almost half of it. It's not surpassing that, right? It's more than 50.
It will be more than 50 in 26.
In 26. So this is a triggering event because, as you could imagine, now the growth will be extremely visible in the recurrent part. When it was only a third, obviously it was diluted by, the rest. So this is how we have, let's say, a better control in a way, how we are pushing the subscription over the time. David. Long answer, but I think you have the framework of all the levers we are using in order to make it happen.
Yes, thank you for the very comprehensive answer. That's clear.
Thank you, David.
Our next question comes from the line of Jason Splino at KeyBank. Your line is open. Please go ahead.
Great. Thanks, Ruben. I think one of the components of your Q4 guide is leaving room for the possibility for longer sales cycles. I wanted to ask about the sales cycles that you saw in Q3, particularly on the industrial innovation side. Did you see or are you seeing longer sales cycles, or is this just a component for Q4 to leave some cushion?
Yeah, thank you, Jason, for the question. Yes, the answer is yes. Yeah, we are seeing. We always said coming into H2, we have a pipeline is more weighted H2 versus H1, and we, in fact, were confident to be online to meet our annual guidance, and really besides what we discussed on lower than expected metadata and also the situation on Centric we just discussed, there's also an impact of decision cycles on large contracts that we need to take into account. I think we had a good quarter in Q3 with 9% growth in industrial innovation, but we also had, of course, more potential of deals that are moved into Q4 or are still in our pipeline to be closed, I would say. And now that's a reality. But I think what's important for you to know is none of those deals we are losing to competition. We are building those and closing them at the right time with the right economics and in the right model, as Pascal said, because we want those contracts to be not one time. We want those contracts to be recurring and like a springboard for value creation and transformation. And this is why we are taking a very focused and specific approach on closing those transactions.
Okay. No, thank you for the clarification. And then on metadata, it sounds like you're expecting similar trends in Q4, and your enterprise motion is not able to compensate for the declining volumes. But what gives you confidence that clinical trial volumes in Q4 won't decline further?
Well, I think the trend right now that we are seeing is there's a declining trend. It's fairly, I think, clear picture that we see in 2025. In our 2025 number, it's an outlook of being in line with Q3 for Q4. This is baked in. The real question will be what's going to be in 2026, the starting point. But as it relates to the clinical trial volume, I don't perceive for Q4 it's similar than Q3. I think this is we have that level of visibility at this point. But what was for us more difficult to assess after the first 6 months is are we able to see that swing back to growth? Is volume stabilizing because it was under pressure in the first 6 months, but still, if there is a balancing effect throughout the year, it definitely would have stabilized our ability to deliver the full year. But looking into the first months of Q3, giving us a picture for Q4, because this is the ongoing assumption, that's why we are assuming Q4 in line with Q3 trend for the volume part.
Okay. May I ask? May I add something? Jason, one thing which is, I want just to be sure we are clear on this. In fact, we are offsetting the decrease of Medidata with the PLM activities, except it's not reported in the line of life sciences. It's in the industrial innovation. Because if you do the math, -3% for Medidata, believe me, we do much more than 10 million with the PLM on the rest of what we do. So overall, we are growing in the life sciences. So I would not you to jump to the wrong conclusions. Nevertheless, to echo what you say, Ruben, we have not yet balanced the effects of the termination of the studies and not being able to compensate with the new starts. So the volume is still at stake, but the enterprise-wide is growing more than double digits, and it's offsetting largely this, except it's not reported in the same lines.
Okay.
So when you do your comparison with our peers, it's an important thing you should take into account.
Thank you. Our next question comes from the line of Michael Briest at UBS. Your line is open. Please, sir, go ahead.
Thanks. Good afternoon. A couple from me as well. Just firstly, it hasn't come up in a while, but what does the M&A pipeline look like? And given some of the operational challenges and organizational changes you're making, do you have the willingness to take on large-scale M&A at the moment? And also, if M&A is not really on the agenda, what about buybacks to capitalize on the weak share price?
Well, I will take it, Ruben, if you want. So no. I think we have a pipeline for M&A. And again, the management change you are talking about are extremely, by the way, well prepared. If you are referring to Centric, Fabrice is with the company for the last 20 years. He was the CEO and the president for more than 5 years. So clearly, the team is prepared for this. So now, the topic is much more for us. It has to be relevant for what we want to do. And all the acquisition we are considering right now should be projected in the concept of, in the framework of the 3D universes we are building. So you need to have a cloud and an AI component in it to justify the fact that we will invest a significant check. Otherwise, we will continue to do some natural extension of what we do. The recent acquisition of ContentServe, for example, is a good example of how we could expand Centric. And we have this also bottom-up pipelines across many domains we do. So no, it's still on the agenda, Michael. But as usual, to do the big move from a transformation standpoint, it has to fit with the strategy of Dassault Systèmes and where we want to go. That has always been the guideline, and we'll continue to do along this way.
Okay. And then just on outscale and cloud, I mean, I think you have a proposition in France for sovereign cloud, there's a lot of sort of interest in that topic currently, and there's AI gigafactories being developed with EU support. So can you talk about your ambitions in cloud, and maybe whether you would look to use the hyperscalers more or less, and the CapEx consequences of that?
Okay. So 3DS upscale is two things for us. One is to address the sovereign cloud, which is a market. Now it's becoming a real market, given what is happening around the world. By the way, it's not only true for France, it's true for many countries around the world. So the fact that we comply with some specific French standard does not mean we are not complying with others. Just keep this in mind. But it's not one or the other. We should do both. So we should continue to develop outscale accordingly to ramp up with the hyperscaler. And since day one, we had this strategy. I mean, AWS is the other part of what we do, and we are relying on them on many things we do. And the fundamental reason is very simple. When we are addressing either industry or geo where we do not have a critical mass, it's much better to start with AWS, because for the one who knows, the business model of data center is very simple. The day you open it, it has to be fully loaded. If it's not fully loaded, you will never have your payback. So the way to do it with the hyperscaler is we are using the hyperscaler to create, if you want, the footprint and the base. And when the base is enough, we open the data center in order to have the full benefit of it and keep the margin for us. That's the strategy. This is very simple. And the more we expand with the cloud, in a way, the more we're going to use also indirectly the hyperscaler in conjunction with 3DS upscale. From a CapEx standpoint, I think we did a good job until now to keep it in the norm. And just because we have this flexibility, we will not be catched by this, if it is basically directly your question.
Okay, that's helpful.
We take our last question from the line of Derek Martin at Bernstein. Your line is open. Please, sir, go ahead.
Yep. Thank you. Good afternoon, Ruben. Good afternoon, Pascal. Two questions, if I may. The first one is on the guidance for new license or upfront license revenue. So revised downward today. Can you help us to bridge previous guidance versus today guidance? And would a decline be the norm for the coming years instead of the kind of stability you were presenting before? And I'm also referring here to Pascal's comment about dividing by two this 1 billion euro revenue line. Is it for the next 3-4 years, or was it a comment for or with a more long-term horizon? And the second question is on the large deal you signed in Q3 for the Stellantis. I'm just trying to understand if it's multi-year hybrid contract, as we saw with other car makers, and if it's the case, why we haven't seen the benefit of that in the upfront license revenue line, the famous 15 to 20% revenue booked upfront with this kind of contract. Thank you.
Thank you, Derek. Let me clarify to the first question on the upfront license, and I guess all the three questions you're asking are very connected, right? Of course. And so I will try to connect the dots with you here to clarify this. Again, when you look at year-to-date and Q3, the growth is in recurring and subscription. It's subscription up 16%. And you reflect on what Pascal said before when we talked about the topic of, CapEx versus OpEx, and whether we give customers the choice. The reality is, the large contracts we are signing, they all have cloud. And with that, we have a model that allows us to create a more ratable revenue line than what the traditional multi-year subscription with upfront license was before the case. And now you consider that all of the flexible hybrids that are more ratable because of the cloud component are reflected in our subscription revenue. And that's, of course, is a catalyst for the subscription revenue growth. And as more and more of the large contracts are in the subscription line in a recurring way, year-to-year recurring, of course, it has an impact on the upfront license part, which is less. And you see that, and that's now the difficulty in terms of the guidance is, it's very hard to assess coming into a quarter, coming into a year, how much of this is going to be recurring versus upfront. And this is why we want to give you a narrower range on the subscription part, because there is a strong contribution from deals that we have signed and that are ramping and that adding to the subscription growth. And by definition, the upfront license is always a point in time, and there can be variability. And that's what you see reflected in the Q4 guide with a larger range on the upfront license part. That's simply what's behind this. And I think I answered also the third question, because for the large deals that we are signing that are cloud and subscription based, you see them reflected in subscription. That's the model going forward. Does it answer your question, Derek?
Yeah, and for the let's say medium-term view, long-term view, the license revenue decline that we should expect, is the flattish aspiration still valid, or it's today no longer the case?
For upfront license?
Yes, just for license, the 1 billion euro.
Yeah, no, it's not going to stay flat. We just said it's going to approach 500 million over time. Cannot be flat if it's 1 billion today, so it will decline over time. But it will be, the growth will be reflected over proportionally in the subscription part on a recurring basis. And with Centric, that's another element of it. It's going to add to this model, and because, as you rightfully said before, multi-year contracts that we signed with Centric, the real revenue growth was in the upfront license part, which is, as we are changing the model, will become recurring. That's what we're focused on, and that's our priority.
Very clear. Thank you.
Thank you, Derek.
This was our last question, so I hand the conference back to the speakers for any closing comments.
So, want to take the time to thank all of you for the time you spend with us and the high-quality question you raised. More than ever, I'm convinced we are doing the right things. And if you look at the market conquest, the dynamic with the large customers we are winning for the last 12 months, we are building the foundation for the growth for the coming years. The fact that we are willing to accelerate the transition to the cloud and to the subscription, I think it's the right things to do. And you should see it positively rather than to challenge us on this way, because I think at the end, we are doing the right things. Now, Ruben and I will be on the road in the coming weeks, and I hope we'll have a chance to see some of you, if not all of you, in the coming days. And I hope we will follow up these discussions. So see you no later than early next year. And for the one I will have a chance, Ruben and I will have a chance to see in the coming weeks. Okay, it's only a rendezvous. Thank you so much. Bye-bye. Thank you.